This is Rod Kusin, Spooman for Risk on February the 6th, 2019, all times on the chart or Central Standard Time. We're going to show you this morning the exact methodology we used for entering our initial trades using our new automated open source programmable strategy. We're going to show you a method that we find to be very useful in eliminating all of the micro decisions that we need to make and focusing our attention on the major decisions that we need to make. So, and by the way, that's all with the use of the strategy. So now, the first thing that we took a look at this morning was the TPO, and this is how I typically go about looking at the TPO. Here we are at 8:30, and we are above the point of control with a pretty good indication that the market is going to be going long, which of course it did initially, but it didn't last, because our thinking was this: if we fail to make a new high from yesterday, this is going to short. And I think everybody would agree with that. So in anticipation of the short, we want to verify whether that makes sense on the premium. So we're going to bring the premium over here. This is our premium chart right here. This is the morning. And here we are at the open. And the premium was down, as you can see. Our moving averages on the premium were dropping. So that was a very good reason to expect that the market would be shorting. All right. Now it's going to short typically at a lower high. And we had a little bump up. And by the way, let me just explain this. We've got two moving averages here. The longer moving average is really designed not so much to trade with, but really to just follow the overall picture of the market. I don't really use the long moving average to execute my trades. I'll use the short moving average, okay, which is the magenta and the green line here. So as we're moving down, I'm thinking, we're not going to get much of a move up here. So I'm likely to look at executing a short on the first move down on the premium. In other words, we're going to let it cycle up, and then on the first move down, that's a potentially good place to execute. And if everything else is in agreement, we go for it. But if it's not, then we're going to wait for the second move up. All right? And you see how on the second move up on moving average, the highs of the premium are still lower highs. So if we're getting higher highs on the ES, but lower highs on the premium, all right, so that's going to be our major setup. That's when we're going to be looking for the execution of the short trade. But now there's another aspect to this that I like to use. I've created a chart where I'm tracking where the JRC CCX indicator is. And I've created a spread on this particular worksheet that uses a variety of different settings. And the objective here is I need to be above 100. I need to be above 100 to demonstrate a overbought situation, and below 100 for an oversold condition. So as the market opened this morning, we were right at that. We were right at that number. And I'm thinking we've got a little ways to go here before we actually short this. So instead, what I did is I looked at some of these other indicators here, and I paid close attention to the CCX at 900 or at 1050. And when that got to be over 100, that's when I'm starting to look at executing this trade. All right. But that wasn't quite happening the way I expected it to. Here we were moving above 100 on our faster setting. Okay. But we were still way below that on the 900 and the 1000. But then I noticed that wasn't the case on the 1500. And in fact, because I adjusted this, let me take this back just a little further so you can see. All right, so now we've got the full spread here. And again, the CCX indicator needs to be above 100, but I choose which of the CCX settings I want to use. And in just the quick glance of this, I could see I was too soon on the 30, and it was getting too late on the 900 or the 1050. So I made the decision to use the 1500. And in what way did I use that? Here's what we do. We set up a strategy that specifically requires that this setting on the CCX be above 100. So I went down into my broadcast indicator here, and I changed this setting to 1500. So all I did, like this, like that, and hit OK. Now, when I did that, okay, it sent the data to our strategy. And I'm going to show you the strategy right now. This is the open source code on the strategy. And this particular condition, 27 or 28, 27 is for a long, 28 is for a short, tells us that the primary condition that we want to make sure we have is the condition known as S12. And S12 up here is defined as the CCX being above 100. The CCX has to be above 100. And it has to correspond with the data feed number 3. Data feed number 3 is right up here. And that's the CCX. That's the broadcast channel, if you will, for that particular condition. So that's the first thing that we need to have. So now let's look at the microbe decisions that need to be made. We've set up a string of different conditions that we frequently see existing at the time that the market pivots. But you can never be sure exactly what condition is going to be optimal. But we've got a variety of different conditions here. And these are not just single settings. They're a string of settings, sub-conditions, if you will. So let's go up here to condition 2. And condition 2 is made up of this string of settings, okay? S1. Let's describe what S1 is. S1 is right here, okay? So we go up here to the strategy, and S1 says that on the ES50 tick chart, we want a stochastic, the Jurek stochastic, hitting a value of 0 for a long trade and a value of 100 for a short trade. So that's condition number 1. Now, condition number 2, all right, pardon me, I'm getting ahead of myself here. The second condition, or subcondition, I should say, is an S6. And what an S6 is, which we've defined down here so that we don't have to go back and forth this way for you, is that the CCX on the ES50 be set to a value of negative 120 for a long trade and above 120 for a short trade. And this is on a 50 tick chart. Then the next setting is that the trend of the CCX indicator has to be positive for a long or negative for a short. But now the next series of settings has to do with the premium. And we've set up an RSX JMA on the premium using a 50 tick premium chart. And that trend has to be up for a long trade, down for a short trade. We then also place a moving average on the premium, and that particular moving average, of which there are 2 moving averages on this 50 tick chart, the trend has to be up for a long trade, down for a short trade, but it also, in the case of a short trade, has to be greater than the second moving average, which we've placed on that data feed. Now, that was a lot, so let me just illustrate it for you with the chart. So here's our premium chart. This is the premium 50 tick. We have 2 moving averages on this chart. And a short trade would be identified by the faster of the moving averages having a negative slope, which it does right in here, and the premium at that time has to be greater than the slower moving average over here. So that's the condition that's represented by this expression right here. Okay? So that's just one of the conditions that we've automatically programmed into the automated strategy. A secondary condition that might prevail looks exactly the same as the first, with the exception of this. All right? We're not going to require that the CCX be at a certain value. Instead, all that we're concerned with is the trend. And that is expressed here. Okay? But there's one other difference, and that is we've added a secondary moving average represented by this condition S. Let's make sure about, yes. We're looking at the MA1 having a negative trend for the short trade, but also the MA3, and you see that's not contained in this particular expression. Okay, so both the MA1 and the MA3 have to have a negative trend, and in this case, the MA3 has to be above the MA4, and that's on a different chart. So this is a secondary set of conditions that frequently prevail when we want to execute our trades. So we can program all of the micro decisions that we would typically manually have to observe into a strategy that can monitor these conditions much more quickly than we do, and therefore, of course, it can execute the trade as soon as those conditions are true. So now let's just go back, because I don't want to bore you with all of the details of all of this. The point of the matter is that we can set up the strategy so that the strategy makes all of the micro decisions, and all we need to do is monitor one or two other major decisions that need to be made, and then we just plug them into the broadcast indicator and let it do its thing. So let's take a look at the results. So as the market rallied up to the high here, the strategy pulled its first short, as you can see here and here. Now it still went up a couple of more ticks. That didn't concern us too much. But in any event, we entered a short trade. And as the market ultimately came back down, it reversed and came back up and tested that high. It never really made it back to that high. And as it did, we replicated the same methodology that we just described, manipulated the CCX manually, and waited for the signal. This is where the signal came in again. Now at that time, and we're going to show you the premium because that's very, very important. Let's pull up the premium. And I'm sorry, let me back up here for a second. Let's look at that first signal. This is where the first signal occurred. All right. And as I mentioned, this may not have been the high, but the secondary high took place right in here. You can see just as this is beginning to slope down, that corresponds right in here. So it was right in that secondary move up on the premium that we passed the initial high, and then finally the market began to drop. But now let's take a look at where the premium was here. So right as this is beginning to drop, right, you can see it right in here. The slope of the premium is down. That's when we caught that secondary, the secondary drop in the Spoos. It was right in there. Right, I'm just using the horizontal line so you can see approximately where we're talking about on each chart. And because we've got two different workspaces here, I'm going to flip between the two of them. But this is how the premium was looking at the time. Now, we pulled a short trade right there. Okay? The strategy pulled that. The strategy at this time does not know how to look for divergence. And manually, when you look at this, you got to say to yourself, that's not really ideal. That's not really ideal. Typically, it makes more sense to pull a short trade when the premium is divergent. And right here, it's not divergent. You just got new highs on the premium. If we're at an equal high or higher high, it would be better to take that short trade here. Okay? Because at least in this case, just look at the value of the moving average. The moving average here is up at 158. And here, it's 156. So it's not hugely divergent, but it is obviously more divergent here than it was here because that's a new high. The strategy doesn't know that. And that's why the trader has to monitor these conditions. Okay? So, where were we at over here? Right. That's where the initial trade signal took place. And this is where the premium is now truly divergent. So the trader has to look at that situation, know that he has a signal, and then determine whether or not he's going to pull it here or at some other spot in this move up. And that's why the strategy has the capability of letting you either execute the signal or ignore it. In any case, it was a nice drop. Now, where are we going to get out? What happened right here was the heads up on what we were going to do next. Because while we are expecting the ES to continue to move down, generally at least to the lower value area here, or the projected lower value area here, we didn't execute any long trade, or we didn't get out of that short trade at least, because what happened right here was a heads up as to what was going to happen. The next major move was going to happen based upon what the premium did right here. So let me show you what the premium did. We got new highs on the premium right in there. So what does that tell you? We had new highs on the premium associated with naked bars on the ES, and therefore we knew this market's going to turn, it's going to come back up. So we need to get out of this short trade because we can't be entirely clear as to where this is going to start its move up. So what did we do? We went back to the CCX indicator. Let's pull that up again. And as the market drops, we're already way below the 100 value line, or the trigger line, let's call it, of 100 on this particular CCX. And we're continuing to move down on these others. So now we've got to decide, which one is making the most sense. And the decision was to use this particular setting in the CCX broadcast indicator. So we literally went back here, switched the value to 1500, and waited for the signal. Let's show you what happened. The strategy got us out of the trade right here. So the short trade is done for. And now we're looking for a long trade. Now it pulls two long trades right in here, and we took them. But as we continued to observe the premium, okay, and I'm going to come back and I'll show you the premium in a second, we realized that we're premature. So we got out of the trade on this move up, put in a stop for break even, and got stopped out. But then, as you can see, it entered two more long trades right here and right here. Bingo, right on the money. Oh, that was beautiful. All right, so let's take a look at the premium again. So this is where we were at when the strategy initially gave us long trades. And you've got to be watching the premium. We already set up the CCX. Now you got to watch for the premium to be divergent. Let's take a look. So where was the premium? Right here at the time of that signal. It's right here. Now, it may require a bit of experience to know this, but while the conditions that we programmed into the strategy are true at this moment, we've already been long on the premium for several bars. And experience shows that typically the best time to execute is right when the turn takes place. This is a little late for the premium. A better place to execute would be here. And why is that? Well, number one, your slope is up and you are divergent. If you compare this low, right, and that value was 162 negative, over here it's 160. Okay, this is really a better place based upon the divergence of the premium. And where would that put us on the strategy? We're over here. So it's already too late. So that doesn't make any sense. And of course, we didn't get a signal. So that opportunity, if you will, doesn't make any sense. There's no other conditions prevailing at that time. So we have to look for the next move. And the next move happens here. And once again, the premium is at 160, right as it's turning up. And that places us right here. And wow, what a nice that was just a perfect opportunity to take the long trade. Now, let's just back up here. Why do we get a signal here? Well, keeping in mind, we've got a variety of different conditions that we've programmed into the strategy. We want the trader to look very closely at what the premium is doing to help him decide whether or not he should take that signal. And as you can see, we're actually sloping down at this particular time. And evidently the strategy setting that caused us to get that signal did not take into consideration what was happening here. Okay? And some of our conditions don't. So that's, again, why you've got to be monitoring the premium. Now, if you were monitoring the premium, you knew that this was a good opportunity to execute. You're not hitting a new low. And there is some divergence here. But this is still fairly low for the premium. And this low on the premium here, this indicates that we may be in trouble on this trade. We could come back down and test that, because this low, if you look at it here, the lowest low on the lowest low here is at 157. Previous low here was also at 157. Okay. Pardon me. I looked at the wrong spot. This is at 153. All right. So while this is lower than these lows, it's not lower than this low. So there is still some divergence here. So that having been the case, we execute the long trade. And where are we going to exit it? A good place to exit that trade, a real safe place to exit the trade, would be when we tag the value of the Spoos that took place when we hit this high on the premium. Okay? And that corresponds with this high, which is at 130.50 and 130.75. That would be a good place to exit this long trade. It's a very safe trade. But we let the strategy decide, once we got up there, where exactly we should exit. And let me show you where that, right up here. Now, strangely enough, we got a new long trade in here. But right as we came up here, there was a short trade, and this is right at 30.50. So we're close. And if not there, right in here as we move up to the point of control. And then we're done for the day. All right? We're done for the day. Pretty remarkable. The point of this video is this. We have an automated strategy that will take care of all of the minor decisions. All you need to do is monitor the major ones and then decide whether or not to take the trade when it occurs. How much more simple do you want it? It works. It works extremely well. So if you'd like to take a demo on this, by all means, give us a call, and we'll be happy to show you more about the inner workings of it. If you go to our website, we've got a brief video in the order section on this what's involved in the automated strategy. And we have reduced our price to a ridiculous number. uh, because this is going to make you money, and we want to see people get involved in this. Um, this is the best thing I think we've ever done, and it really, really works. I'm Rod Kusanen, Spooman for Risk.